Welcome to the third episode on the investment and taxation. So, in the episode 2, we looked at the fixed deposit and then we looked at the EPF and PPF as well. So, there is one more component which is known as NPS. This was introduced about 2 decades back because earlier it was not there. About 2 decades prior, 2004, it was not there, and it was introduced in 2004. Ideally, it was introduced for the government sector because there is always a political debate. If you look at it about old pension scheme and new pension scheme, across states it's happening, across India it's happening. It was introduced in 2004 as a new pension scheme, which is you contribute to the pensions. The employee contributes to the pension, not just the employee. Any citizen can contribute to his own pension. So that was introduced, and the old pension scheme was abolished. That was in year 2000. So till up to 2009, it was specifically for the government sector, for the government employees, because those who joined prior 2000, that is after 2004, they will always be linked to the NPS scheme. The old pension scheme is what the government used to provide pensions. So that was taken off, particularly for the government sector. So the new pension scheme, NPS, was introduced in 2004, started off with the only for the government employees. The employee contributes, and there are exemptions, and employer can contribute as well. And then 2009 onwards, it was rolled out to the corporates and even the other citizens in India. They can opt for the NPS scheme as well. There are different banking entities. There is a government body which takes care as the central registry of the NPS. They take care. There's a government body, and the pension funds could be from the banks as well. So we'll quickly look at the NPS as well, and as well as the mutual funds. The mutual fund part also was more predominant in last about 40 years, is what since 1994 onwards, is what the mutual fund has really caught everybody's attention, the public's attention. Everybody, instead of investing in share, they take the option of mutual fund. We look at that as well quickly, and what are the whether how is the exemptions for both NPS and even the mutual funds, that we look at as well. So this is the part 3 of the savings and tax benefit. This is of course on the NPS. So as I had earlier briefed you, this is Social Security initiative of by the central government, the National Pension Scheme. It was started off in 2004 for the government employee, and later on it was rolled out for the public as well. That's on 2009. So that is where it got rolled out. So here again, if you look at it, NPS is actually, you can link it to the market, whereas PPF and EPF is not. So there were discussions earlier in Parliament whether because it's all fixed, so why not link it to the market? And that is where instead of doing with PPF and EPF, the NPS has that facility. So you can even link it to the market. 50% can be linked to the market in the sense stock market. It can be up to 50% is what. Because if you look at the share market, how it behaves, generally you get, if you're investing for a long time, there could be short term ups and downs. But if you're targeting for 3 years, about 3 years, generally it will even out, and you'll get somewhere about 12 to max of 14-15% is what is the interest on the, I mean, the returns will be 12 to 14%. Whereas if compared with the EPF and PPF or fixed deposits, it's far less. So fixed deposit is the at one end, then it is PPF, EPF, and then comes the market. Market in the stock market, the returns are around 12 to 14%. There could be exceptional cases. We'll leave out those exceptional cases of maybe a higher return or a much lower return. We leave out, but otherwise it's about 12 to 14%. NPS can be linked to the bank as well. One more benefit is this one as far as NPS is concerned. It still, whatever you invest comes under 80C, but you can. This is what made it attractive. I think it was made in 2014, if I'm not sure, but 80CCD 1B, another 50% you can gain the exemption while filing returns, another 50,000 apart from. So the deductions is 1,50,000 plus 50,000. So it's about 2 lakhs from your taxable income you can reduce while filing your return if you have sufficient proof that you have invested. So that way it makes it even more attractive. Another 50,000 you can up. So if you're in a higher tax bracket, maybe if you're earning more than particularly 10 lakhs or 12 lakhs or more than that, maybe you could think about investing in NPS, and particularly your contribution. If you make personal, apart from what is deducted from the salary, and the employer may contribute to the NPS, apart from that, if you are contributing voluntary, called as voluntary contributions, those voluntary contributions gets an exemption of 50,000 under 80 ccd 1b. That makes it attractive as well as NPS is concerned. It's again exempt, contribute, accumulate, retrieval. So one flip side of it is that you got to wait till your retirement to get the entire corpus of money. And if you go out of the employment by any chance, you can still have to contribute 6,000 per annum. And there are different accounts. Tier 1, I'll not go into the details. You have tier 1 account, tier 2 account. Tier 2 account, there are much more flexible about removals, whereas tier 1 account is mandatory, particularly when you're employed or when you're opening an account. Tier 1 account is, this is towards your retirement, so NPS. So it's about, looks at the post retirement is what you can ideally get that amount as either as pension or lump sum. There are different options available. I will not go into the details of it, but yes, towards investment, towards your retirement, ideally you can consider NPS as well. Mutual funds. This is what, if it is equity linked scheme, then it under ATC, um, you can claim the benefits under ATC, the mutual funds. And again, as I said, it needs a lock-in period is 3 years. Mutual fund generally has somewhere about 12 to 14% is what is the returns you get. So you could go for the mutual funds as well with a lock-in period. But otherwise, if you want to build your kitty, yes, you could go to NPS instead of the mutual funds. In mutual funds, yes, if there is a capital gains, there are short-term capital gains and long-term capital gains. We'll look at that point. And again, till up to 2020, the dividends was not attracting any of the taxation, but from 2020, dividends are treated as income from other sources and it gets taxed. So, which means on a particular year, if you, even if you have invested long back and if you are getting dividends, then apart from your salary, this will be clubbed as income from other source and it gets taxed as well. Short term, long term. Short term, within 1 year, if you're going to sell, particularly on the capital gains, then it gets taxed. TDS gets attracted within 1 year. And long term, if it is more than a year, then it is considered as a long term. And particularly on the capital gains, say for example, if you invested 100 rupees, then it becomes 110. That's a capital gain. So there is a taxation part. So that capital has appreciated. So that is separate. And dividends is what the I mean the market or the company pays is dividend out of their profit. That becomes treated under income as other sources, the dividend part. Whereas when you sell that stock, it becomes a capital gains, and there are short-term capital gains and long-term capital gains. So this gives you an idea on where to invest, looking at how to get benefits from the ATC, and with NPS there is a voluntary contribution, another 50,000 you get an exemption. The other part I didn't discuss is that on the real estate, the principal part you it gets under ATC, and the interest part you have, you can claim the exemptions. But I am not going into the real estate part because there is a huge sum of money you need to invest. It should be anywhere about 40, 50, depending upon the city where you are, be 40, 50, 60. That's a huge investment. In the time of uncertainty, we don't know how long one can be in the same city with the same employment. You are going to be there. So ideally, I'm not sure. Maybe if it's a first home, you could go for the real estate purchase. But if you look out as an investment, I would not suggest the real estate part, particularly the rentals. Compared to rentals in the investment, it's not that huge when you compare the rentals in that investment. For that matter, yeah, the gold and gold bonds seems to be much more lucrative as of now, because last 1 year, if you look at it, the gold has prices have really skyrocketed. Even as of now, the market is doing well. The mutual fund or the stock market is doing well. So maybe you could look at the options either through the mutual fund or through the NPS, because you claim the tax exemption, additional tax exemption through your voluntary contribution as well. I hope you found this presentation useful on the investment and taxation. Do subscribe to my channel. Thank you. Good day and cheers.